Hello, my CFA friends. How are you, my friends? Today, we talk about different types of fixed income securities. We're going to talk about fixed coupon, variable coupon. We're going to do a little mortgage computation. It's not going to be a particularly mathematical reading, but it's going to be a great introductory reading to the various fixed income structures. So let us get started. Our first structure is the bullet bond. And in a bullet bond, you basically are going to be receiving the coupon periodically, perhaps annually or semi-annually. That'll be just the interest. So you are simply, if you're the issuer, simply servicing that interest. And then at maturity, you will be repaying the principal or the face value, the $1,000, and that will be referred to as the bullet, my friends, the bullet. Another structure is the fully amortizing structure. Now, what do we mean by fully amortizing? Think about a traditional mortgage, right? So let's say we take a 30-year mortgage, and the payment of that mortgage contains quite a bit of interest and a little bit of principal. But if you keep paying for the next 30 years or 360 months, you will have eventually repaid the entire mortgage principal amount. So in that sense, a mortgage, a traditional mortgage, is a fully amortizing loan. Every payment will contain a portion of principal and a portion of interest. And if you make all the payments, the loan amount will be fully extinguished or amortized. A variation of the fully amortizing loan is, of course, the partially amortizing loan, which essentially means that you're still making a payment that contains interest and principal, but the principal portion is not as big as it would have been in the fully amortizing loan. So by some point in the future, when the maturity does occur, you still have a portion of outstanding principal that you have to repay. And that portion of the outstanding principal is referred to as the balloon payment. So be careful. It's not the bullet payment. Bullet payment refers to the full principal amount on a traditional fixed coupon bond, whereas the partial principal repayment on a partially amortizing mortgage is referred to as the balloon payment. Then I've got some provisions here, and a bond issue could have a sinking fund provision. That simply means that the issuer has committed contractually from the outset to redeem a certain portion of the issue each year. So there is a schedule to follow, and the issuer is redeeming a certain portion. For example, I could commit to redeem 10% of the outstanding issue every year. Now, if you get a question about the credit quality of this, you can always conclude that a bond that has a sinking fund provision will have a higher quality than a comparable bond without a sinking fund provision. The logic being that the sinking fund is forcing the issuer to reduce his leverage over time. So it's basically increasing the likelihood that the issuer will be able to meet the obligation, and it's giving extra comfort, therefore, to the investor. Another idea here is the distribution waterfall. Now, this is typically linked with asset-backed securities, and in a later reading, we're going to talk about what these are. But for now, we're just going to define the distribution waterfall. And typically, that would happen, for example, if we had a special purpose vehicle like a collateralized debt obligation or a CDO, which has been tranched sequentially, i.e. a sequential pay CDO, What I mean by sequential pay CDO, and again, I don't want to digress too much and cover that here because it's not a focal point of this reading, but in a sequential pay CDO, tranche A, or the top tranche of the structure, will have to get paid their principal before any of the lower tranches, for example, tranche B or tranche C, receive any principal amounts. The principal is being repaid sequentially from top to bottom, and that would be referred to as a distribution waterfall. As promised, let's actually do a mortgage computation. We're going to look at this fully amortizing mortgage and try to prepare an amortization schedule in Excel. And also, we're going to use our beloved Texas Instruments calculator to show you also how you can do that there. Okay, prepare an amortization schedule for the following mortgage with monthly periodicity, meaning that the mortgage pays monthly payments. The loan amount is $300,000. The interest rate, and this is the annual interest rate, of course, is 5.5%. And the term measured in years is 25 years. Of course, that will be 300 months. So let's jump in Excel and first calculate the payment and then also the amortization schedule. So I've got the assumptions here. The loan amount is $300,000. Interest rate is 5.5. The term of the mortgage is 25. The parameters for the payment function are rate, number of periods, PV, and in square brackets, you can see that future value and type are optional parameters. So the first argument here will be the interest rate, and the interest rate is 5.5 on an annual basis. We're going to divide that by 12 because we want monthly periodicity. We need 25 years for the mortgage. However, with monthly periodicity, we will multiply that by 12. So we're going to have 300 months. And the present value of the loan will be the $300,000. We don't need a future value because the mortgage will be fully amortized. And therefore, our payment will be $1,842.26. Okay, but now let's prepare the amortization schedule. And here I'm going all the way down to month 300. So if performed correctly, we will end up with an ending balance that is 0. So let's find out. So my beginning balance will simply be 300,000. The interest for month 1 will take the beginning balance. Of course, I will be applying the interest on the beginning balance. And then multiply by the interest rate, but this is the annual interest rate, so I'll have to divide that by 12. And hopefully that's going to calculate my monthly interest. I want to dollarize here the interest rate so it doesn't move as I drag down. So there's my interest for the first month. For the payment, we can simply point to the payment we've calculated already. And now the logic here, and if you just think about the logic is the ending balance, right? The ending balance should be the beginning balance plus interest minus payment. That's the logic, really. Think about it. Why should that be the case? Well, I'm taking the beginning balance. I am adding the interest because I'm accruing the interest on the beginning balance, and then the payment is amortizing that down. So that's how I'm going to get the ending balance. So therefore, if I come here, I could simply use the sum function on these 3 values, and I've got my ending balance. As you can see here, I have repaid a tiny bit of interest, $467 in month 1. So out of that payment, $467 was actually principal. So the beginning balance for for month 2 will point to the ending balance for month 1. That's fine. The interest will just drag down. Notice how the interest has declined a little bit because the starting loan amount is now smaller. The payment shouldn't change, and the ending balance should decline a little bit again. So you can see here we're performing this correctly now. So if I drag down, I will produce the entire amortization schedule. And now, most excitingly, if we go down to month 300, so let's go down, 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 we should expect to see an ending balance of a big fat 0. So let's find out. Ta-da! You actually got a 0 here. Notice month 300, we had a starting balance of 1834. Then we experienced a little bit of interest in the amount of $8, but then the payment, the fixed payment, was 1842, and that brought us down to exactly 0. So that's essentially the amortization schedule that a bank will prepare. And you will have to follow that amortization schedule for the next 25 or 30 years in order to fully repay your loan amount. But next, let's actually have a look at how we would do all that in the Texas instruments. Okay, our first job is to calculate the payment. So, of course, we're going to use the third row of buttons, the time value of money buttons here. And the very, very first job we've got always with these calculations is clearing the memory. So we're going to start with second future value. That's cleared the memory. Now, N is the number of periods. We already know that we need 300 periods, so we're just going to input 300 and press N. That serves to store the value. No need to press Enter here. Then I need the interest rate, but of course, I need the monthly rate. So I'm going to divide that by 12 first, and then I'm going to store it as IY. My loan amount is 300,000. I'm going to store that as PV. And then, as you know, we need to calculate the payment. So I'm going to press compute, and then I'm going to press payment. Okay, and I'm getting exactly the same answer, 1842.26. So that is the payment. You might think, well, that's great, Martin. That's great. But what if they, for example, ask me to calculate the outstanding balance of month 14, or the interest for month 14, or the principal for month 14? Do I need to, calculate 14 lines of data like Excel did? And luckily, we don't have to do this because we've got an amortization schedule on this lovely calculator. And basically, we can reproduce what Excel does very easily with our calculator. So what you're going to do is you're not going to clear the memory here. It's very important to keep the data in the TVM buttons. But what you are going to do is you're going to press second PV, which is the amortization function. Second PV is the amortization function. You're going to need the value for month 14. So P1 is going to be 14. And when you go to P2, that's also going to be 14. So you're going to set both values to 14. If you want month 14, that is. The balance will be 293,259. Okay, so you can see here that the balance is 293,260. So Excel, of course, is rounding here. So that is the outstanding balance at the end of month 14. And if I go down, I can see how much principal was repaid during that month. And if I go down again, I can actually see the interest payment for month 14, which, as you can see here, is 1346.38. Next, we're going to look at variable interest debt. So this is debt that does not have a fixed coupon. The coupon can go up or down. The first one that we're going to look at is the floating rate note, or the floater, or the FRN. So the coupon of the floater is, surprise, surprise, floating up or down as a function of interest rates. So you can see here the formula will take the market reference rate, so the SOFR, the SONIA, the IONIA, the LIBOR, and then I'm going to be adding a credit spread to account for the fact that my issuer is less trustworthy than the reference rate. Okay, remember the reference rate is based on large multinational banks. So my smaller company may have a lower credit rating, so I'm going to pay the MRR plus a credit spread. Now, if the MRR goes up in the future, if the interbank lending rate goes up, so will my coupon. And if the MRR goes down, my coupon, my cost of borrowing will also decline. That's the idea behind floating rate notes. Another type of bond that doesn't have a fixed coupon is the step-up bond. So step-up bond is a bond that uses a predetermined schedule to increase the coupon rate. For example, for the first few years, the coupon may be 3%, but then it could step up to 4% and eventually it could step up to 5%. So the idea here is that we're giving some breathing space to the borrower in the early years. So if he's, cash burning or struggling in the short term, he's paying a lower coupon initially, but in the future, the hope is that as he becomes more profitable, he will be able to afford the larger coupon. Therefore, the coupon steps up. Now, the example is the leverage loan. So here, the coupon may increase as a function of some metric. I've given you an example here. For example, the leverage ratio. If we increase our leverage ratio, then we will have to pay a larger coupon. Another type of bond is the CLN. That stands for credit linked note. So here, the idea is that your coupon may increase because your credit rating has worsened. So in the leverage loan case, it was to do with the leverage ratio. In the credit link, no, it's to do with your credit rating. But fundamentally, these two types of loans are very, very similar because the coupon is going to be really increasing as a function of your credit risk. Then I've got the PIK bond, or the payment in kind bond. Now, what happens here, my friends, is that I could tell you, hey, Martin, I'm gonna pay you a 20% PIK coupon. And you might think, wow, that's fantastic. Nobody gives me 20% in the markets. So is this a good deal? Well, typically it's not such a great deal, my friends, because payment in kind bonds mean that you're not actually getting any cash coupons. What you're actually getting is more pieces of the same, typically junk paper. So, for example, if the starting value of this bond was $1,000, and in this case we have 20% PIK coupon, what I'll do at the end of the year, instead of giving you $200 in cash, which would have been quite rather nice, what I'll do is I'll issue an additional $200 worth of that bond. So now instead of you owning $1,000 of this paper, you will now own $1,200. So you can see here how this can very, very quickly spiral out of control. The idea is that that bond's principal will be repaid at some point in the future. But typically that's issued by very speculative companies, and in a lot of cases, this has resulted in some spectacular defaults. Green bonds with step-up events, what we're looking at here, this is typically issued by governments, although it can be issued by private corporations as well. The word green here, of course, suggests that these bonds proceeds are used for some sort of environmentally friendly project. So, for example, reducing CO2 emissions. So the government here issues the green bond for the project, but there is a step-up event. So to motivate the issuer to achieve its goals, right? We said, for example, reduce CO2 emissions. We will actually have trigger events or step-up events which will cause the coupon rate to increase should they fail to meet their target. So, for example, if you fail to reduce CO2 emissions by 20%, then the coupon will have to increase. And then, of course, we've got the index-linked bonds. These are bonds linked to inflation. So the idea here is that we're trying to protect you from inflation. Now, these bonds can be capital protected, i.e. the capital is linked to the consumer price index, or only the interest portion is linked to the consumer price index. The better one, of course, is the capital, because if your capital is growing at inflation, so will the coupon, because remember the coupon is calculated as a percentage of the principal, so both the capital and the interest will grow with inflation. So at maturity, your purchasing power is hopefully relatively protected. That's assuming that we trust how governments calculate inflation and that the official statistics are in fact in line with the with the inflation that you and I experience on the ground. Yeah, well, that's probably not true, but anyway. So that's the capital index, and the interest index is only adjusting the coupon component. So here, as an example of that, we will be looking at the Treasury Inflation Protection Securities, or the TIPS. So whenever you come across that acronym, TIPS, it's telling you this is a government-issued securities that is inflation protected. Next, we talk about callables and putables. So what is a callable bond? A callable bond, you can think of it anyway as having a straight bond component. So that is the option-free component of the bond. And then here minus means short. So effectively we have a short position in a call. That, by the way, is from the point of view of the investor. So POV investor. Okay, so this is looking at it from the point of view of the investor. The investor is long a straight bond and short a call option. Now, what do I mean by short a call option? He sold a call option to the issuer, so the issuer has the right but not the obligation to call back the bond early, to repay the bond early, to refinance the bond early. So clearly that option sits with the issuer, so the issuer will benefit from that. And in order for us to be able to even sell that bond, we have to sell it cheaper than the comparable straight bond, and therefore the callable bond will also have a higher yield than the comparable straight bond. Now the putable bond, you can think of it as the investor has a long position in the option-free bond as well as a long position in a put option on the bond. In this case, the investor has the right to put the bond back to the issuer. So the investor has the right to ask for his money back early. Typically, that will happen if current market rates are higher than the coupon rate of the putable bond. So I can get higher rates elsewhere. I'm going to exercise the put, going to get my mana back. I'm going to invest my mana at elsewhere at higher rate. So in this case, because the investor owns the put, the investor benefits. You can see here mathematically we are adding something to the straight bonds price. So the putable bond price is more expensive than the comparable straight bond price, and therefore the yield of the putable is lower than the yield of the straight bond. Guys, if you're finding this a little bit challenging, don't worry too much. I'm glancing over it here because this is a big level 2 topic. So I'm going to be helping you with bonds with embedded options at level 2. Don't panic. That is a big level 2 topic. For now, we're just making our baby steps. We're just warming up, getting in the pool, testing the water, acclimatizing, but no big computations for level 1 in this area. And I've given you an example of what's known as a call price schedule. So typically, let's take the example of the callable bond here. There will be a period of call protection. Let's say we've just issued the bond. So you can see here that between years 4 and 5, I can call the bond. I'm the issuer in this case. I can call the bond at 103.5% of par. So that first of all implies that I can't do that before year 4. So there is essentially 4 years of call protection. The bond cannot be called during the first 4 years. But between years 4 and 5, I can call it at a premium to par value. Remember, par value will be 100%, so I can call it, I can repay the obligation at 103% of par. And notice how the call schedule declines as we move towards maturity, right? Because at maturity, remember, we will have to repay the face value of the bond, which is 100%. Now, the other big thing here is the convertible bond. So you can think again mathematically as an equation about a convertible bond. Think of it again from the point of view of my investor who owns a straight bond, but also, plus here means owns, a call option to acquire the equity of the company, the common equity of the company. So when I have a convertible bond in human words here, what do I have? I've got a fixed income instrument which at my discretion I can convert from fixed income into common equity. So I can become just a good old regular shareholder by giving up my bond. Clearly, that's going to be more expensive than the comparable straight bond because you're buying the bond and the option, okay? And also this is going to be benefiting the bondholder because the bondholder is effectively the option holder. Now, there are a few terms that we need to know here, and these are terms also that crop up at level 2. So convertible bonds is a level 2 topic again. But conversion ratio is effectively the number of shares that you can get when you convert $1,000 worth of a bond, right? $1,000 par value. So how are we going to calculate that conversion ratio? Well, we're going to take the par value of the convertible bond, and we're going to divide by the conversion price. Okay, so that may be given in the question. We're going to just divide the convertible bond par value by the conversion price. And I'll give you an example in a minute. And then another concept that we should be aware of is the conversion value of the bond, which is the value of the bond based on the current share price. So remember, the conversion ratio will tell me how many shares I can get upon conversion. So let's say conversion ratio is 50. I know I can get 50 shares, but now I want to look at what the share price is. Let's say the share price is $10. We'll take 50 shares times $10. That's going to give me $500. So the value of the bond, should I wish to convert it into stocks, would be $500. Now, we can figure out whether the call option is in the money or out of the money based on the relationship between share price and conversion price. So share price is simply the current market price of the stock. Conversion price is based on this relationship here. It's based on the conversion ratio and the par value of the bond. So if my current share price is above the conversion price, then the call option is in the money. The investor will therefore be profiting should he decide to exercise the option and convert. And therefore, the bond, it will actually behave more like equity than fixed income. And what I mean by that is that the bond price will closely track the movement in the share price. So it trades as an equity equivalent. And the opposite is true, of course. If the share price is below the conversion price, then the option is out of the money. The investor is unlikely to exercise the option, and therefore the convertible bond will behave more like a fixed income equivalent. But I will be giving a lot more on all that at level 2. Okay, let's calculate the conversion value of a bond based on the following data. So I've got a par value of $1,000, coupon rate of 2%, maturity of the bond is 6 years, conversion price is $25, and current share price is $30. So the first thing I want to do is calculate the conversion ratio. Remember, this is the number of shares I would get upon converting $1,000 worth of face value. So to get the conversion ratio, I will take the par value of the bond, which I know is $1,000. And I'm going to have to divide by the conversion price of the bond, which is $25. Okay, and that's going to give me 40. So once again, what does that 40 mean? That means that when I take $1,000 of face value, I can convert that into 40 shares of common equity. But the question is asking me about conversion value, so I need to know the formula for conversion value, which is simply share price multiplied by conversion ratio. So how much is that bond worth in terms of common shares? Well, the current share price is $30, and I will be getting 40 shares. So that's giving me a conversion value of $1,200. Notice that the conversion value is greater than the par value. And also notice that the current share price is greater than the conversion price. And that those things imply essentially that the option is in demand and that the convertible bond will tend to behave more like equity than fixed income. On this slide, we're going to look at warrants and contingent convertibles. So what are warrants, first of all? So you may have come across the concept of bonds with warrants. So instead of selling a convertible bond, which effectively has an embedded call option to purchase the equity, what we're going to do is we're going to sell you straight bonds, but we're also going to attach to the issue some warrants. And these warrants are nothing but call options to acquire the equity. So how is that different from a convertible bond, you might ask? Well, it's different because in the convertible bond, the option is embedded and is not detachable, whereas in the case of the warrant, you can actually detach the warrant, you can trade the warrant separate from the bond, and obviously the bond separate from the warrant. So the key thing here is warrants are detachable. You can essentially trade them separately as call options on the exchange. So you might think, why would an issuer attach warrants to a straight bond? Well, the warrants represent additional value for investors, meaning that investors would be prepared to pay more for a bond with warrants than for a bond without warrants. And if investors pay more, that means that the yield of the bond is actually lower. And that's why we call warrants yield enhancers. When a company issues bonds with warrants, it's effectively able to borrow more cheaply, to enhance its yield. The next item is the contingent convertible, which we lovingly call COCO. Okay, COCO, contingent convertible. Now, this one is as the name suggested, a convertible bond. It's a fixed income with an embedded call option. But be careful, because this call option is not necessarily to the advantage of the holder of the COCO, because the conversion occurs automatically upon a trigger event. Now, what might this trigger event be? Typically, these COCOs are issued by systemically important banks. And if the bank breaches an important capital ratio, like, for example, the Tier 1 equity capital ratio, so the CFA doesn't really get too much into the Basel Accord at level 1, but obviously we have to maintain certain capital ratios for equity and debt. So if we trigger the event by breaching the minimum capital ratio, then the bond will automatically convert from debt into equity. And that effectively will create additional equity cushion for the bank. So in other words, the contingent convertible is much more likely to convert as the share price drops, which is a bit ironic because your regular convertible bond is more likely to convert when share price increases. And also, why would you use contingent convertibles? As I said, they are issued by large, so-called too big to fail financial institutions. So because the debt will convert into equity and it will allow the bank to have additional equity cushion, the idea, the intention here is to try and limit systemic risk. Remember, don't confuse systemic and systematic risk. Systematic risk is exposure to the market. Systemic risk is the risk of a system failure, perhaps because of interconnectedness or because of a large player defaulting. And as we come towards the end of the reading, we need to have a quick overview of the legal and reg situation. And I want to define a few types of bonds. The first bond is the domestic bond, and it's probably easiest to just look at an example. So I'm in the UK, so I just chose to use a UK company here. So let's say I took Tesco supermarket here, UK well-known name in the UK company. Tesco will issue a bond within the United Kingdom. So no surprise there, Tesco issuing, a UK company issuing a bond in the UK will probably count as a domestic bond, right? No surprise there. What is a foreign bond? Well, the UK company now goes and taps a foreign market. So Tesco issues a bond in the United States. Now, why might a UK company want to do that? Well, they want to borrow dollars. And what better place than borrowing dollars than the United States? And if they borrow dollars, why would they want to do that? Well, maybe they want to expand in the United States. Okay, Euro bonds. Now, these are bonds that are issued outside of any single jurisdiction. So, i.e., they are issued in multiple jurisdictions. They are less regulated or unregulated. They tend to be bearer bonds, and I will explain what a bearer bond is in a minute. And they can be issued in any one currency. So, for example, you can have a dollar-denominated euro bond, in which case it would be referred to as a dollar bond. You can have a yen-denominated euro bond, in which case it'd be referred to as a euro-yen bond, and so on. The next type of bond is the sukuk bond, and this has to do with Islamic finance, with Sharia law. I'm not going to get into the detail of this here, but basically, as per Islamic finance, you cannot charge interest. So instead of charging interest, we are going to be rewarding effectively the lender here through rental cash flow. So the lender in this case is considered to be the owner for a period of time. So instead of getting interest, is getting rental cash flows. And finally here, registered versus bearer bonds. As I said, Euro bonds tended in the past to be bearer bonds. That meant that nobody or the trustee did not have a record of who owned the bond. So literally, the owner of the bond was the person carrying or bearing the bond. The best example of that is cash, right? If you find a $10 note in the street and you just pick it up, it's yours, right? You're the bearer, okay? So bearer bonds are like cash. When you hold the cash is not attached to anybody's name. Whereas a registered bond is obviously a bond where your name gets registered in a database and you are known to be the owner of that bond. So going forward, Euro bonds are registered bonds, but in the past they used to be bearer bonds. And finally, we're going to finish the reading with a little tax consideration, if I may. We're going to talk about so-known original issue discount, or OID. So what is OID? OID is applicable to zero coupon bonds. Remember, zero coupon bonds are pure discount instruments. So if you, let's say, had a face value of 100, perhaps today you're buying it for $80, right? So if I had the face value at 100, but I'm paying for it today $80, my original issue discount is 100 minus 80, which is equal to $20. Now, notice that the zero coupon bond does not pay any coupons, so does not actually provide any income. So how do you get taxed on this thing? The question, of course, is the option when it comes to bonds is you can tax it as income every year, or you can tax perhaps the final capital gain. Well, if a bond has the OID treatment, the original issue discount treatment, then what we do is we take that discount, the $20, and then we prorate it for each year of the bond's life. So let's say the maturity of this bond is 5 years. Okay, let's say the maturity is 5 years, and we know that the OID is $20. Well, we'll take that $20 and we divide it by 5 years, and we're going to find that we have essentially $4 of income every year. Now, remember, that's not actually cash paid into your account. That income is not paid into your account. That income represents, if you like, the appreciation of the bond each year. So the investor will have to pay tax on that $4 as if that $4 was income for that tax year, which is pretty bad news, right? So this is what I call an alligator. The zero coupon bond is not actually providing income until maturity, and yet you're having to spend on it in the form of taxes on the appreciation. However, on the positive side, there will be no capital gains tax at maturity. My friends, thank you very much for watching this reading. I hope you found something useful here, and I'm looking forward to meeting in the next reading. Until then, have a great day.